All right, so I want to show you all something that's incredibly important, and that is how to read a loan estimate. Through my process, I take everyone through each line item and describe what's going on, why that's there, so they can understand and be confident moving forward. It's important to know exactly what you're paying for, and also so you can compare lenders as well. When you are comparing loan estimates from different lenders, don't focus on the monthly payment because taxes and insurance can be made up. They can be different in any situation, but in the end, they will be the same no matter what. It's the monthly principal and interest that is important to you. Four things that are most important: the interest rate, the cost of the interest rate, the origination points, the lender fees, processing fees, and the APR. If those are aligned, the rest falls into place. By the end of this video, I want you to be able to read this loan estimate with complete confidence. A loan estimate, or an LE, is a document that the lender must send you within 3 days of your application. It's law. It breaks down your interest rate, your closing costs, your monthly payment, all the crucial details of your loan. That is one of the most important documents in the whole process, but also one of the most misunderstood because it comes in the beginning and it's not explained thoroughly correctly. Let's start with page 1. This is high level summary. Here you'll see the loan amount, the interest rate, your monthly principal and interest, and whether your rate can change. If you see anything checked yes, like prepayment penalty or balloon payment, pause and ask about it because on most standard loans, 99% of first home buyer loans, they should not have prepayment penalties or balloon payments. This box specifically shows how your monthly payment breaks down. Principal and interest. Principal goes towards paying off the house. Interest goes towards paying off the lender. Mortgage insurance is an insurance that covers the risk that the lender takes in giving you the loan to pay for the house. Taxes and homeowners insurance, a little bit more self-explanatory, especially here in Texas. Property taxes, everybody knows those. They're high around here. Those are part of your monthly payment. And then homeowners insurance are also part of your monthly payment. And then down here, you see all of them combined to create the total monthly payment. Now remember, for loan estimates, taxes and homeowners insurance are estimated. They can change. In the beginning of the application, the lender will not have all the information needed to have an exact number for you. But he or she is doing it to the best of their ability, hopefully. Part you want to compare between lenders is the principal and interest, because that's the part the lenders actually control. Right? In this cost to closing box, this shows you your estimated cash to close, the amount you'll need to bring on closing day. The closing cost is one number. That is all of the extra fees, title fees, escrow fees, um, prepayments, and so forth. But the cash to close includes your down payment and the closing costs put together and credits that we'll explain at the end. So the cash to close is the important number here. That is what you will bring to the table in order to close on buying your house. All right, now page 2 is where most people get overwhelmed. But once you understand each section, it's really straightforward. All right, you've got origination charges. These costs come from the lender. So this is important to compare each lender on, this section A. Things like points, underwriting fees, and origination fees, sometimes processing fees. As you see here, processing fee, the loan amount and points will come as a percentage, like 0.71% or 1.2% of the loan amount in order to buy down your rate. Right now, services you cannot shop for. These include things like appraisal fees, something you're going to pay up front most likely. Credit report fees, something you may or may not pay up front. Flood certification, that's determined by the county. And standard stuff you or I can't really control. All right, and C, services you can shop for, which means you can go and call multiple title companies and ask for their fees and see which one's the most cost effective for you. It includes, like I said, title insurance, settlement fee, sometimes the survey, as you see here, if that's needed. Sometimes it's not. That depends on the specific situation. Most buyers don't know this, but you can shop around for these costs, especially title. So Section E, taxes and other government fees. This has the recording fees. It covers the charge to essentially record all this information into a database. Right, now Section F, prepaids. This is important also. In each of these sections, you can see the total of everything in that section at the top next to the bolded word as well. Prepaids always include 12 months of homeowners insurance. And like I said, we won't know how much that insurance will be until we get into the loan process and we start shopping around for homeowners insurance companies. So that's why it's an estimate. And then once you, the borrower, finds the company that you choose, then we'll have an exact number. But for now, like for example, this 1800, that's just an estimate. Prepaid interest, on the other hand, that is not an estimate. That is determined by the exact amount each day that your interest is charged. So there's 30 days in a month. Let's say there's $2,000 of interest each month. So you divide that by 30, and that's how they get the number. It's determined by the interest rate and the amount of days in each month. So that is exact. That's something we cannot change. And that's determined by what day of the month you close on your house. They're not fees, they're just payments made up front. In Section G, you have your initial escrow payment at closing. Each lender is going to have different standards for how many months they want in escrow, but homeowners insurance and property taxes is always included unless you waive escrow. So for example, this lender specifically only wanted 2 months. So if it's $150 a month at that 1800, then you're adding 2 months in that escrow. 2 months of property taxes is over 2000. And so what that does is, in case you're ever a month or two behind on your monthly payment, they have that much cushion to be able to negate any risk there. Your monthly payments into escrow is what the lender collects to build your tax and insurance account so that at the end of the year or whenever your homeowner's insurance is due, they can then pay it for you. All right, and the last section, H, other. This might include HOA fees, home warranties, other optional items like owner's title insurance, which is usually paid for by the seller anyways. All right, so section J, total closing costs. This includes a accumulation of every section, including if you have seller credits, lender credits, what have you. So total closing costs, that is, like I said, an estimate because of some of the things that we don't know yet. Down payment, that is what you agreed on in the contract. That won't change unless you change how much you want to put down on the house. The deposit that you put down when buying your house is part of that down payment. So whenever you pay a deposit, you will subtract how much you pay from the down payment, and then you paying that much less in the cash to close. Okay. Now in this instance, this borrower is getting seller credits. So what that means is credits will be taken away from the total amount in the closing costs. So in this case, the borrower is getting seller credits, and what that means is those amount of seller credits will be taken away from the total closing costs, which will reduce the estimated cash to close. So the accumulation of all of these numbers, the down payment plus the closing costs, minus the deposit, minus any credits or other adjustments, will be your cash to close, what you bring to the table. Page 3 is often ignored, but it helps you compare lenders because it does show your APR, which is different from your interest rate, and your total cost over the first 5 years. If you're comparing lenders, this is a great way to see who's actually giving you the better long-term deal. All right, other considerations. This section tells you things like whether the loan can be assumed, what the late fee is, or whether your loan is likely to be serviced by another company. A lot of lenders will sell their loans to investors a month or two after the loan closes. Everybody's got to make their money somehow. That is your full walkthrough of how to read a loan estimate. If you want me to read your loan estimate and give you a breakdown of if you want me to read your loan estimate and give you an honest breakdown, no pressure, just send it my way. I'm happy to make sure that you are getting the absolute best deal. If this video helped you, hit like, submit a comment, and let me know what else you want me to break down.